This is Inspired Industries' final report with Professor Kwong, summer quarter 2015.
For Inspired Industries' mission statement, Inspired Industries aims to provide customers with great value for their money, to offer competitive prices while still meeting customer expectations on quality and features, to offer excellent customer service in order to foster customer loyalty. We aim to achieve high returns on equity, high ROA, and to maintain a high stock price for our stockholders. For Inspired Industries' vision statement, Inspired Industries' vision is to maintain production of durable customer goods to the global market at a competitive price in an attempt to provide high levels of customer service and satisfaction to build and attract valued consumers and investors.
The main strategy at Inspired Industry is to provide the best consumer durable goods by differentiating our products with top quality and new and up-to-date features. We also believe our prices will attract consumers that could appreciate top quality and long-lasting consumer goods that will give them complete satisfaction and will produce consumer loyalty. Lastly, we plan on selling our offerings primarily to consumers domestically.
In today's agenda, we will be talking about performance targets, analysis of functional strategy, operations and product management, financial management, and SWOT analysis.
At Inspired Industries, our corporate strategy is Inspired Industries has pretty much based its prices lower than the regular competitors. It is our belief that we should provide top quality at an affordable price so that we can build customer loyalty and improve our market share. Our products were top quality and had all of the latest features that were demanded according to survey. Inspired Industries envisioned more of a profit by doing this strategy. Our main strategy is to meet consumer demands and preferences and how to maintain the interests of the consumer. And Inspired Industry leads the market with its average on having the lowest sales to ensure consumer loyalty. Our business plan currently relies heavily on making the customer happy and not what our rivals are currently doing in the respective market. Inspired Industries is currently experiencing turbulence as we have made changes to cut costs on our cost of goods sold. We have currently closed one of our manufacturing plants to help these issues, but that does not mean that we do not plan to keep expanding into the foreign countries as well as domestic. We plan to have mass improvements to increase our net income, return on assets, and return on equity. Inspired Industries also put a valiant effort into the research of the market industry to avoid being left behind in the current sales.
Business strategy. Inspired Industries implements differentiation in various aspects. Although not proven yet, a focus in production efficiency, pricing per value, and corporate social responsibility are the primary characteristics of Inspired Industries' core values.
We at Inspired Industries had 6 main performance targets to reach. These covered most of the important aspects of our company. It started with ROA, then ROE, market share, stock price, unit production cost, and total net income. I will discuss later on how we performed in these criteria. Starting with return on assets. We had an actual negative return on assets of 0.18 and our projected was 1.31. The variance was 114%, and yes, this is very high. We did not expect so much cost to hold us down. We had lower inventory turnover than we expected, and outsourcing definitely would have solved much of our production problems and also improved sales, which we will discuss later on. Our next performance target is return on equity. For year 5, the actual was negative 9.39. Our projected was 2.02. We were short over 5 times our projected amount. The reason for this can be summed up by low net income, which plagued us in much of year 5. Market share for year 5 was averaged to 17.64% of industry sales. Our target was 18%. Although this seems like we did well in sales, the fact that we had such high costs led us to have net income problems, which in the bigger picture led to a disappointing performance in sales. Total net income for year 5 was negative $968 million. Contrast this with our projected net income for year 5 of $650 million. We were short by about 250%. The reason for this was high production costs that started to creep into our company in early year 5. Also, this affected our stock price and our ROE. We will discuss later on how we began to deal with this problem. For year 6, starting with ROA, our actual was negative 6.5, projected was 1.63. This is a variance of 500%. ROE was negative 9.77, projected was 2.5, variance of 490%. Our market share was off by 24%. Our stock price was off by 40%, and total net income, as you can see in the slide, it was off by 215%, and our unit price costs were still a bit over than what we projected. As you can see, this follows a trend that started in year 5 in my previous explanation. We started having these high cost problems in year 5 that we battled as a team to resolve. We slowly started brainstorming ideas, and even though we were very short in year 6, and admittedly we are disappointed in our results, our team efforts led us to have a turnaround in the last quarter of year 6 with positive net income, which is a fundamental key in improving all these shortcomings. More sales, lower costs, higher net income. These are the key ingredients to solve a problem. As you can see in this bar graph, our main issues in reaching our targets for year 5 and 6 were in ROA and ROE. Market share and UPC were not that off. However, the shortcomings in ROA can be explained by our high production costs and our mismanagement of resources. We could have outsourced our plants to a more cheap area such as livestock, and we could have had better return on our assets through that. For ROE, it could be summed up to low net income, reducing our return on our investors' stock. As you can see in year 5, we trailed our peers in ROA, ROE, and market share. We started to have less sales than we expected. We believe that this could have been a combination of factors, from a miscalculated features and quality, also price, and for ROE and ROA, it's a combination of low net income and high costs in our factory, which was not outsourced. As can be seen, year 6 was very similar to year 5. However, it was not without serious brainstorming from our group members and combining our talents in order to make a turnaround at the end to have a positive net income. We troubleshot our problems, and once again, these lied in high costs, which was holding down our net income, and related to that was not outsourcing earlier, and also a rethinking of our marketing strategy in order to increase sales would also be needed to continue our turnaround.
Due to the challenges the company faced during year 5 and 6, Inspired Industries had to make drastic measures to its sales force, salary levels, and commission rates. For 3 quarters of year 5, we were making a negative net income. Even though our sales revenues wasn't completely off the margin in comparison to our competitors, it appeared that cost of goods sold was killing most, if not all, of our net income. Though the sales force is valued by our organization, cuts in employment had to be made to save the company from drowning in its own expenses. In conjunction, we felt giving incremental raises in salary and commission each quarter could subsidize the losses from cutting our sales force. The whole idea behind increasing salaries and commission is to drive the incentive of our sales force to sell more units. Implementing these new challenges had us move away from our planned schedule. At the end of year 5, it was obvious that our ship was sinking. Even though cutbacks on the sales force were made, we did not know if it was the right move. Also, we had no idea whether or not increasing sales and commission worked. In the beginning of year 6, quarter 1, we saw our negative earnings get worse from negative $571 in year 5, quarter 4 to negative $723 after changing the sales force. Our new plan obviously wasn't convincing us that our changes were working. As we furthered one more quarter, we saw substantial improvements in net income as a result of cutting sales force and increasing salaries and commission again. In quarter 2 of year 6, we had to reduce we had our negative net income reduced to just negative $14, and by quarter 4, the company started to see a profit again.
Due to poor performance during prior quarters, Inspired Industry was forced to make drastic adjustments in multiple areas. In this case, changes in production price, advertising spending, and unit sales had to be revised according to our results. This meant that the projections on the 2-year plan were altered because of the challenges we faced. Some experimentation was made to identify whether or not we could stimulate net income back to positive earnings. For instance, Year 5, Quarter 4, the average price for each area was $10.27, $10.26, $10.30, and 56. With this said, our decision in the following quarters was to make our prices well below the industry average to gain a competitive advantage over our competitors by selling more units. It turned out to be a disaster, with net income resulting at negative $723, which was our lowest to date. We did, however, find some light when we decided to raise our prices to compensate for the lack of units sold. In product pricing, our initial plan was to beat our competitors in prices to gain a competitive advantage in market share. We found we were doing decent in year 5, sitting at 3rd place up to quarter 4 when we dropped to 5th with 16.2%. In response, we dropped our prices substantially, making us the most affordable vendors out of all 5 companies. Though results from year 6, quarter 1 proved to be disastrous, dropping our market share further down to 14.1%. In response, we learned that our prices had to be raised, which in turn contributed in raising our net income in the following quarters. The projected unit sales was very inconsistent throughout each quarter with a huge planned to actual variance percentage. We theorized that the inconsistencies came from the drastic changes we made to the sales department, pricing, advertising, and production factors. Also, there could have been a possibility that the regression analysis ran using the formula with the highest adjusted R-squared was not for the best choice.
For advertisement, spending was consistently raised according to inflation in the 2-year plan. The outline for advertisement spending throughout the 2 years was to increase advertising expense by 5% every selling quarter. In selling quarters, our plan was to hold advertising expenditures to save money in costs and spend when demands peaked. Though due to poor sales performance and net income by year 6, we had to implement changes to our planned advertisement procedures. It was not until quarter 3 of year 6 we realized too much cash was being held, and we needed to use it to invest in order to sell more products. We spent virtually 20% more in America 1, 2, and 3 in advertising as a result. It is not clear whether or not it helped substantially, but we saw gradual increases in sales throughout the following quarters.
For Inspired Industries, as far as our R&D, for year 5, we had a target of around $400,000 that we were going to spend, and we ended up with an actual amount of $880,000 while producing Model 3. When it comes to year 6 for Inspired Industries, we had an actual amount of $440,000, and we had a target of $400,000 while we were producing Model 4. For Inspired Industries, when discussing beginning inventory and total storage expense for year 5, we had a target amount of $145,000 as far as our total beginning inventory, and expected a total storage expense of $14,500. We ended up with an actual amount of $156,000 as far as beginning inventory, and had total storage expense for $15,600 for year 5. When discussing year 6, we had a target amount of 100,000 units with a total storage expense of $10,000. We ended up with an actual amount of our total beginning inventory of $56,000 and a total storage expense of $5,600 for year 6.
As can be seen in year 5, we did not plan any bank loans, time CDs, bond repurchases, stock issues, or dividends paid. Reason is we were worried about losing our solvency by spending our cash in areas that were not priority. However, in year 6, we did plan on issuing a buyback of stock actually in the second quarter. However, the actual was that we bought back every quarter of year 6 in order to save our stock price from plummeting. Our main game plan with regard to the decision-making process was to combine the talents and the strengths of the different group members who all come from diverse educational backgrounds. Working together as a group in a brainstorming scenario yields very positive and productive results. We did have some adversity in our group, however, we solved it as professionally as we could. At the end, we can say that we followed through with most of our plans that we did devise through brainstorming, and at the end, there were improvements in group communication.
Inspire Industries variance analysis for year 6 income statement. Our company failed to meet its financial goals. This was due to high costs. In example, our operations profit was negative 186%, which is very unfavorable to the company. Also, interest expense variance was 100% due to the issuance of bonds. However, at the end of year 6, we started to see some improvements in terms of net income. This makes us think that Inspire Industries is heading in the right direction. In the cash flow variance analysis for year 6, we can see that Inspire Industries had 2 important issues. This was the lack of net income and a high operations outflows. The balance sheet variance analysis for year 6 tells us that cash balance always remains favorably despite the shortcomings. Low sales is seen as low inventory turnover. We had more liabilities than planned, and accounts receivable turned out to be as planned. Continuing with balance sheet variance, we can see that our issuance of bonds saved the company from insolvency, and no bank loans were required during years 5 and 6. However, Inspire Industries failed to pay dividends.
We are now going to talk about the SWOT analysis for our company, and we're going to start with strengths, one of which was inventory costs. We were able to keep our inventory low, meaning that we were not spending that much on holding inventory, and we were also able to keep prices below market value. Also, we were able to produce top quality products that consumers liked. However, we did have big weaknesses, one of which was our net income, which were negative throughout years 5 and in the beginning of year 6. Labor costs was also a big problem, as we were spending a lot on employees working overtime. Also, shipping and transportation costs made us lose lots of money in our cost of goods sold.
For this portion of the SWOT analysis, I'm going to be covering the opportunities as well as the threats. As far as the opportunities for Inspire Industries, market share was a huge area that we could use huge improvement in as we begin to increase our net income. Outsourcing is also another valuable opportunity that we can take advantage of so we can lower our labor costs. Also, adding additional lines for production is something that can also help us gain a competitive advantage in the market as far as producing our product. As far as the threats, the threat of seasonal changes had a huge effect on our net income as well as our sales. The competitive prices amongst our rivals was also a huge key factor when dealing out the product. Rival differentiation in product was also another key component because it gave them a huge competitive advantage in net income when comparing to our company at Inspire Industries.
For Inspired Industries' future plans, we plan on buying marketing reports to learn about our consumer preferences, which will help us spend more efficiently in terms of products. We will also spend on advertisement by increasing it by 5% every selling quarter, keeping existing buyers. We will also spend money on our sales force by increasing their salaries and commissions by 5% to salary, 2% to commissions, to increase their incentive to sell. And we want to save money by going overseas, by opening up a plant in Nystock. This will help us save in cost of goods sold. So the main lessons learned in our project is to outsource early to maximize cost savings. This means opening up a new plant early in the stages of the game, and understand consumer preferences to know exactly what they want and not overspend on research and development. Also, we learned we must follow through with a strategy even though our company isn't doing well in the game.
Inspired industries, time management is a major area that we need to pay attention to. As far as time management, there are three components. One, understand team roles to coordinate efficiency. Two, show up on time. And three, communicate any difficulties with the rest of the group through messaging or through phone.
Yeah.